Over 30 years, the Dow Jones climbed from 3,000 to over 35,000 points. It is one of the most consistent bull markets in financial history. This era encompasses roughly 7,500 individual trading sessions. To the naked eye, the upward drift of the macro trend suggests a persistent daily buying pressure. However, when we map the closing price of every single one of those 7,500 days, the data splits into two perfectly equal bins. Exactly half of the sessions closed higher than the previous day, and exactly half closed lower. This 50-50 distribution indicates that at a daily resolution, the macro bull trend provides no directional edge. It suggests that applying generic technical indicators in a vacuum, without specific temporal filters, yields results consistent with random chance. Most traders mistake the long-term trend for a short-term probability advantage. They see a rising line and assume their standard technical setups have an inherent edge when the daily math is actually a coin flip. To find a measurable statistical advantage, we must shift from generalized technical patterns to situational analysis, isolating precise moments where the market's behavior deviates from a random distribution. We will test this by focusing on a high volatility window in the UK market, the first 5-minute candle of the FTSE 100 index. Survival in a 50-50 market requires a transition. You have to stop reacting to the continuous price noise and start executing within highly specific, tightly focused situational windows. We begin with a dataset spanning 1,250 trading days in the FTSE 100, covering the last 4.5 years of market action. Every morning at 8 a.m. London time, the opening bell triggers a 5-minute period of rapid price discovery. To isolate our signal, we filter the grid, ignoring days with positive opening candles to leave exactly 526 negative sessions. The mechanical trigger is a buy order placed at the extreme low of that first 5-minute candle, entering where early selling pressure is most visible. We test the viability of this entry with a baseline defensive parameter, a fixed 20-point stop loss. In this model, a trade is successful if the price moves far enough in our favor to allow the stop loss to be moved to our break-even entry point. Mapping the outcomes of these 526 instances reveals 186 losses and 340 winners. By isolating this single opening anomaly, we have established a baseline success rate of 64.6%. By stripping away 700 days of irrelevant data, we transformed a 50-50 market flip into a measurable situational advantage. While a 64% win rate is strong, the 20-point stop loss is capital inefficient, creating a risk profile that limits total yield. We can optimize the returns by tightening our risk. We will cut the stop loss parameter by half, risking only 10 points per trade. This optimization creates more immediate stop-outs, accumulating 2,400 points of historical losses. But the trade-off is expanded capture of the winning days. By risking 10 points to target a 25-point mean runner, total profit potential reaches 7,200 points. We defend this potential with a trailing mechanic. The moment the market moves 5 points into profit, the stop losses move to break even, removing all risk from the trade. As price rises, we scale in, adding new positions at every 5-point milestone to compound trade size. This aggressive compounding exploits the trend day phenomenon, ensuring the strategy extracts maximum possible yield. Statistical edge is only the starting point. True alpha is generated by the mathematical asymmetry between restricted, frequent losses and aggressively scaled winners. The math is objective, but execution is not. Operating this optimized system requires a human to endure a constant cycle of small, consecutive losses. Human neurobiology is evolved for loss aversion. When we face a string of small losses, the brain triggers a stress response that makes it physically difficult to follow the plan or hold a winning position to its target. This creates the behavioral gap, the distance between what a mathematical system returns on paper and what a human trader actually extracts in real time. There is a professional misconception that top traders operate without feelings of fear or doubt. The data suggests they are simply better at ignoring them. Analysis of top portfolio managers shows a tight cluster. They are only right 45 to 55% of the time. They are elite because of their payoff ratio. They possess the psychological flexibility to let winners run, despite intense internal pressure. Most systems fail when a trader reacts to a spike in internal data, usually a thought like, "I cannot afford to lose this trade." The core axiom of disciplined trading is that a thought does not execute a trade. Transient internal feelings must be separated from the mechanical action. To bridge the gap, we use the ABC protocol. Acknowledge the internal stress. Breathe to regulate the physical response. Then choose the external action required by the math of the system. When a mathematically proven system bankrupts a trader, it is almost always a failure of behavioral control, not a flaw in the quantitative model. A cohesive trading philosophy requires three components: situational analysis to find the edge, asymmetric math to exploit it, and behavioral flexibility to execute it. In the FTSE opening model, these layers function as a single engine. The situational base layer identifies the setup, the mathematical layer manages the risk, and the psychological layer overrides the biological stress of the trade. This psychological layer is built to ignore internal fear and FOMO warnings, ensuring that the trader executes the exact math the strategy requires to remain profitable over time. High-performance trading is not about achieving 90% accuracy. It is about isolating a high-probability context and structuring risk to outpace the natural variance of the market. To capture long-term returns, you must decouple your physiological responses from your mechanical execution. Profitable trading is engineered with objective mathematics, but it is sustained through the discipline to act in accordance with those numbers, regardless of the emotional state of the trader. True alpha exists at the exact intersection where rigorous situational analysis meets complete psychological control.